and 5 items. If the significant differences in the product itself is happening at the fork and spoon level, that would be the category level. It's not happening at the color level, then it's not happening at the item level. First choice is the right one for the second question. Third question, 50 minus 20 is 30. That's the third choice. Fourth question, replacement cost refers to the cost that Louis must pay to replace an item that he sells, which is the price that he must pay to his supplier for the replacement of an item sold. By the way, if you're wondering who's Louis, there actually are 2 cougars in the Houston Zoo. One is called Shasta. Shasta's companion is called Louis. There is a Louis, the cougar, in the Houston Zoo. Okay, finally, the mathematic question of the bunch. So, if I begin the day with 80 and I add another 10, that means that during the day I had $90 worth of inventory available for sale, ready to be sold. I received $40 from customers for selling inventory to them, but 25% of the 40 is profit, which means that 75% of the 40, or $30, is the cost of inventory that I sold to them, also known as cost of goods sold. So if I had $90 of inventory available for sale, and if the cost of goods I actually sold was 30, the cost of the goods not sold at the end of the day and still an ending inventory is 90 minus 30, or 60. And that concludes the quiz. Any questions? Go ahead.
Yes, I don't understand why for question 2 the answer is A and not B. Like, is there a thing behind it? Why it should be category level?
Right. So basically what you want to do is focus the accounting where basically there is a difference between the 2 inventory items or the multiple inventory items. If you're stocking 5 different inventory items and they're all basically the same in terms of how you produce them, how you use them, what they cost, and there's only a superficial difference in those 5 different color items, then you can just account for them all as one single group. However, at the category level, between forks and spoons, there are significant differences in cost, use, process, etc. And so, because forks cost you different amounts of money than spoons do, and by process, I mean the way in which you sell them differs. Sometimes you'll put, forks in one area of the store, spoons in the other area. Maybe, and this is a bit of a stretch, but just to roll with it, maybe forks are sharp. And so the packaging for forks might be a little bit different than packaging for spoons. Because forks and spoons at that category level, not just on the superficial color level, are different. That's where you would have different inventory analyses and different valuation processes performed. Okay, Shafai, was that helpful? And okay, okay. Hopefully it was. Bob, go right ahead.
Can you go over question number 5 one more time, please?
Sure. So
Thank you.
first you ask yourself, okay, what is the cost of the items that were available to be sold? Or as the textbook calls it, cost of items available for sale. Then you want to calculate the cost of the items that you actually did sell, cost of goods sold. The difference between the cost of the items that were available to be sold and the cost of items that were actually sold is the cost of the items that were not sold. And another way of saying cost of items not sold is cost of items still in inventory at the end of the day, which is what we're asking about. Well, okay, how much is the cost of items that were available for sale? 80 plus 10, because we began the day with 80 and then we purchased another 10 for the sale. Well, what was the cost of the items that were sold? Well, we got $40 retail price, cash and the cash register from customers when we sold what we sold. A quarter of the $40 is profit. 3/4 of $40 was therefore the cost of goods sold. Well, if $90 is the cost of the goods that were available for sale, and if $30 was the cost of goods that were sold, then 90 minus 30, or 60, must be the cost of goods not sold, available to be sold, but not actually sold. And those are the cost of the goods still sitting unsold in inventory at the end of the day. That's why 60 is the correct answer. Hey, Bob, was that helpful?
Yes, Professor, thank you.
Sure, my pleasure, my pleasure. Other questions? Going once? Going twice? And okay, that concludes our quiz. Let me go ahead and reshare my screen. And let me pull this up. As you can see, I have preemptively and proactively yellow highlighted the 5 lines, actually 6 lines in total, that I think I'll be able to cover today and that I believe, therefore, will be on our quiz on Tuesday next week. Now we'll see how far we actually get, but I think that won't be a problem. I will also briefly talk about Part C, but since that, to a certain extent, is just more of the same, but more complicated, I probably will not consider that to be quizable. But we'll see what happens today as we proceed through the class. Okay, so here we are, Part B, Inventory Estimation Techniques. And as you now know, 9-5 was on our quiz today, and that's where we stopped. So let's go on to 9-6. Just a quick reminder, why are you doing these estimates? You know, these are all about estimating your inventory and estimating the cost of the goods that you sell. Why can't you just keep track of your actual goods sold? Well, actually, we do that. We no longer really need to use estimates because we use computers. And so this is a somewhat obsolete area of the of the textbook. However, it is also true that accounting systems, data systems can make errors, and it's always helpful to know, because of that, estimation techniques so that you can hopefully spot an error if it should pop up in your computer system. Okay, so what happened today in illustration 9-6? Well, you had inventory at the beginning of the day. You bought more inventory. The sum of those two numbers, inventory available at the beginning of the day, plus the additional inventory that you bought today, are the goods that were available for sale today. There are two different columns here, though. One is the cost column, which is what you spent to buy the inventory to begin with at your cost. Then they have retail value, that is what the customer will spend for the goods if and when they buy your goods. And in a normal system, unless something goes wrong, you're going to want to sell the product for more than what it cost you to buy it. That's how you make a profit. And therefore, the retail numbers in the first three rows are going to be higher normally than the cost numbers. Okay, well, at this point, you say, total goods available for sale, 347,200 in terms of what it cost me to buy them to begin with. 560,000 in terms of what my customers will hopefully buy that pay me to buy them from me. And you immediately say, my cost number divided by my retail number is 62%. Okay? That's another way of saying that is I have a 38% profit margin, but cost as a percentage of retail, 62%. Why is that important? Well, if at the end of the day you look in your cash register and say, how much stuff did my customers buy from me today? How much money did they pay me today to buy stuff from me? Oh, look, there's $400,000 in my cash register. Okay, well, at a retail level, in terms of retail numbers, if I had $560,000 worth of stuff to sell today, priced at retail, at what customers would pay me if they bought all of it, and if they actually did pay me $400,000 to buy most but not all of that content, well, then the retail value of the inventory that was not sold today, even though it was available to be sold today, and therefore the retail value of the goods in inventory at the end of the day is 160. Okay, hold on. If we were to assume that the cost number is always 62% of the retail number, well, if this retail number is 160, the estimated cost of my ending inventory at retail, then 62% of it is the estimated cost of my ending inventory. And finally, if I had, and now we're back in the cost number, or the cost column, if we had 347,200 worth of goods available for sale, and if 99,200 of them were unsold at the end of the day, then 248 of them must have been sold during the day, and that is the estimated cost of goods sold. You might be thinking, aren't we backing into this? Yes. Is backing into anything a good idea? Not really. I mean, the better idea is just keep track of your own inventory. But this is sort of plan B. What if you're not keeping track of inventory? Or what is more common, what if you just want to get a sense of what these numbers should be so that you can catch an error in the data system if it should occur? Okay, that's 9.6. Any questions about 9.6? 9.7, vocabulary. When you buy a product for $4 and you decide that you're going to try to sell it for $10, the initial markup, okay, you buy it for 4, you're going to sell it for 10, the markup, the initial markup, or your initial estimated profit is 6. What if you then increase the selling price the next day from 10 to 12? Then you have an additional markup of 2. What if the day after that you say, 12's a little bit too much. I'm going to back down my price to 11. Well, then you have a markup cancellation of -1. Ooh, what if the next day you bring it all the way back down to 10, the price? Well, then you have another markup cancellation of -1. Ooh, people are still not buying this thing. What if the day after that you reduce the price from 10 all the way to 7? Well, then you're no longer just eliminating a markup. You now have a decrease in the initial selling price. That's a markdown of 3. What if the day after that you say, marking it all the way down from 10 to 7 was a little bit too extreme? Let me bring it back from 7 to 8. Then you are canceling $1 of the markdown. Initial markup is the initial profit. Additional markups are the extra profits if you continue to increase your selling price. If you change your mind on the additional markups, you have markup cancellations. If you say, I better mark down my selling price, okay, that's below the original price, that would be a markdown. And if you think you mark something down too hastily or too dramatically, you might cancel a markdown, at least in part, which would increase the price again. Now, if you're thinking, can I see a couple of numerical examples of that? Here they are. And I won't go through the numbers in detail because these are just 2 additional examples, very similar to the one that I just walked through. But this is how it works. Okay, questions? Okay. 99 and 910. Okay, they're really part of the same problem. 9 are the givens. I began with a certain amount of inventory that cost me money to buy. And since I want to make a profit, the retail price, what I hope and expect to sell it for, is going to be a bigger number. I also bought or purchased additional products during the day at a certain cost. Those products I'm going to mark up to a higher price or a retail price because I hope to sell them and make a profit. Now, after I initially mark them up to mark up the purchases and the beginning inventory to a higher retail price, I might mark them up some more. And on other days, I might mark them down. Overall, I expect to sell $434,000 of inventory, and that's retail. So when I look in my cash register at the end of the day, I'm expecting to see 434 there. Okay. Then, with all this, as you can see, the basic estimation process is pretty much exactly the same as the one that we reviewed in illustration 9-6, the first illustration we looked at today. The only difference is, instead of having one number for retail price value of goods that are available for sale, the 470 and the 160, we have initial retail price value of the 470 and the 160, plus additional increases in prices or markups, minus additional decreases in prices or minus markdowns. The 10 and the 8 conceptually, or more specifically, the 10 and the -8 are the only differences between what you see on the screen and the first example we reviewed today. And the point is that the retail value is not only the initial retail price that you establish. The retail value of what you're trying to sell should include any subsequent changes in retail prices as well. Okay, questions about that? Okay, good, good. So on to part C. And again, this I don't intend to quiz, so I'll only spend a minute or two on talking about it briefly. The only difference between this analysis and the previous analysis is that in the prior analysis or analyses, you computed a single percentage of cost to retail. Here, what you're saying is, why compute a single one when the goods that you have available for sale consist of both old inventory or beginning inventory, inventory available at the beginning of the day, and new inventory, instead of coming up with one percentage, which would be a percentage somewhere in between 62 and 64.68, why don't you have slightly different percentages, one for the older stuff and one for the newer stuff? This should strike you as being slightly more accurate than if you just had one percentage for everything, which would be greater than 62, but less than 64.68. Now, just to make life even more complicated, in 9-14A, you have a third layer or even newer purchases. And so in 9-14A, you would have not one, not two, but three different percentages. In this case, 63%. See, up here we had two different percentages. 62, the older stuff, 64.68, the newer stuff. Those percentages are carried down here, but we have even newer stuff, even more purchases, which itself has, excuse me, a ratio of 0.63. And then you don't add any layers next year, but you do sell out all of the newest material. Well, if you have three different percentages for three different layers of inventory, and you sell one layer out, then you're back to having two layers of inventory with these two different cost to retail percentages, which you see here. Okay, so in my opinion, there isn't really anything new in these examples. I did want to show them to you. There is this one concept that says, instead of one percentage of cost to retail, if you have different components of inventory, it would be a little more accurate to have a slightly different percentage for each one. And it is important, but I think it's of minimal importance compared to other things that we're looking at, which is why I deem it not quiz-worthy, not quizzable. Any questions, though, about that? Okay. So guys, it's 13 minutes before the hour. I do have Pod D to go through. We'll probably finish Pod D, almost certainly we'll finish Pod D well before 11:30. I do want to introduce the project, which is something that currently appears at the end of our syllabus, but I'd prefer not to have it all wait until the last day. So I will review Part D. That will conclude what you will be quizzed on Tuesday next week, and then I'll somewhat review, slightly review the term project with you, or at least introduce it at some depth. Okay, so that's the plan for the remainder of today's session. And now on to Part D. Okay, illustration 9-16 says, my inventory balance, remember, inventory is an asset, is 123. And let's say I was using LIFO. In 2024, I changed to FIFO. Okay, now there are limits on how often you can make these changes, but in certain situations you can. And so if you were selling milk made by the company Parmalat in those special containers where the milk does not have to be refrigerated and doesn't really spoil, I mean, eventually it does, but not right away, then if you were selling non-spoilage milk, you might have been using LIFO. It's possible. If you then switched to milk that could spoil, then you might switch to FIFO. Could be other reasons that you'll get into when you take, if and when you take advanced accounting, why it might be appropriate to make that switch. But the bottom line is you were on one inventory method and your cost was 123 of the inventory asset. You switch to another one and suddenly, only because of the switch, the value of the inventory goes up to 146. So what you want to do is you want to increase the value of the asset by 23 from 123 to 146. That increases the value of the company. And therefore, you would think you would increase revenue by 23. However, special case here. What if the asset, the inventory that you are increasing the value of was bought more than a year ago, was actually bought 2 or 3 years ago? If you want to increase revenue by 23, that's a problem because the inventory was bought years ago. And so revenue related to the inventory is revenue of a few years ago. But at the end of every year, revenues and expenses are swept into retained earnings. And so assuming that this is relatively old inventory whose value you are changing, you would increase the value of the asset inventory by 23. You would increase the value of the related old revenue by 23. But old revenue has been swept into retained earnings, which is also an equity value column. But still, it's not the same as the column called revenue, which is current increases in earnings. And so the increase in the value of the company, when it's related to an increase in an old asset, which means that you really want to increase old revenue, well, the increase is booked in an equity value column called retained earnings, because that's where old revenue is closed to at the end of every year. Okay, questions about that? Okay, good, good. So next up, 919. So this, what we just went through, actually requires us to visualize what we really want to modify. And then if the account that we want to modify no longer really exists because it has been swept into some other account over time, then we have to figure out, well, which column or which general ledger account did the old general ledger account get closed into? Because that's the one that we need to modify. So we just went through an example of having to modify old prior year revenues, which are now swept into prior year net income, which gets swept into retained earnings. Likewise, if I say, hey, I have some inventory and it was sold a couple of years ago. And if I then say, uh-oh, I screwed up on the journal entry that debited cost of goods sold expense. If I screwed up the debit to cost of goods sold expense 2 years ago, do I correct the account called cost of goods sold expense today? No, because cost of goods sold expense 2 years ago was basically swept into net income, which then got swept into or closed into retained earnings 2 years ago. And so if you want to correct or modify an old journal entry that affected cost of goods sold 2 years ago, when you correct it, instead of debiting or crediting cost of goods sold from 2 years ago, you need to debit or credit retained earnings, because that's where cost of goods sold wound up from 2 years ago, wound up today. Okay, questions about that? Questions? Okay, 9-20, it's the same idea, except this is a little more complicated. In each year, last year, 2023, and this year, 2024, beginning inventory plus new purchases of inventory equals, there's actually a subtotal, goods available for sale. Goods available for sale this period minus ending inventory at the end of this period must be the cost of goods that I sold this period. And cost of goods sold is an expense. Now, revenues minus expenses, which include cost of goods sold, minus any other expenses, is net income. And net income, the end of the year, gets swept into retained earnings. Okay, so what is this chart telling us? We were using the estimation process to estimate what ending inventory at the end of at the end of last year was. And we overstated our estimate for ending inventory by 800, which is a good reason to never estimate and to instead invest in computer equipment so you can track the actual flow of each inventory item. But they didn't do that. And so they overstated the amount of inventory that was on the shelves at the end of the year. Okay. If beginning inventory plus purchases minus ending inventory is cost of goods sold, if your ending inventory number is too big, overstated, then your cost of goods sold will be too small, understated. Okay, well then last year, still in the 2023 column, if your revenues are correct, but your cost of goods sold expense is understated, then your net income, which is revenues minus expenses, will be overstated. And if your net income is overstated, your retained earnings, which is where net income gets swept into, will also be overstated. Okay, so let me pause for a moment. Any questions about the left column? What is happening last year? Okay, good. So the plot thickens. The inventory that you had on the shelves ready to be sold at the end of last year is the beginning inventory at the beginning of this year. And so if last year's ending inventory, if the number is too big, it's been overstated by 800, then the beginning inventory at the beginning of this year will be overstated by 800. Well, if inventory at the beginning of this year is overstated by 800, then based on this same formula, cost of goods sold this year will be overstated by 800, which means that if your expense is overstated by 800, revenues minus expenses or net income will be understated by 800. And at the end of the year, when you sweep this year's net income into retained earnings, your bookkeeper says, oh, well, isn't that interesting? Last year, we overstated retained earnings, net income and retained earnings by 800. This year, you're understating net income and thus retained earnings by 800. And so from a net income perspective, last year's overstatement cancels out or offsets this year's understatement. When the two offset each other within retained earnings, you basically wind up with a correct number for retained earnings. Okay, so that's a summary of basically the way these columns work, the way that inventory, which is an asset on your balance sheet, interacts with cost of goods sold, which is an expense on your income statement. But remember, the bottom line on your income statement, net income, kind of goes backwards and impacts a number on your balance sheet, retained earnings. Any questions about that? Okay, a little complicated, but I'm hoping what you're thinking is it's sort of just another variation on the same theme that we've been going over time and again in this chapter. Okay, so I'm about to close the textbook and talk a little bit about the project. Before I do, let me do my usual going once. So sometimes this teases out, if you will, a question or two. Going once? Going twice? Ah, it did. Okay, Andrew, go right ahead.
Yes. So is this like just like a law of accounting that it'll just correct itself in the next year? So like if I accidentally understate something in 2023, can I just not worry about it in 2024 and it'll just fix itself? Or do I still need to like keep an eye on it?
So this is actually an initial introduction in the sequence of financial accounting courses that you're taking in a concept known as timing, Timing differences. At the end of 2023, there is a problem, which means that if at the end of 2023 you issue your financial statements and people are looking at your 2023 financial statements and 2024 hasn't happened yet, you've got a problem. You've got incorrect 2023 financial statements. And yet you are correct in the sense that if you just wait a little more time, the error, in a sense, self-corrects. Or the way that I would put it, the error in the next year is also an error. It just happens to balance out the error in the first year. So it's not so much as you're correcting errors, because the errors on an annual basis are still there. It's just that the misstatement to retained earnings is no longer there. Timing differences are something that you actually come across first in income taxes. There are lots and lots of timing differences in income taxes. However, in 3368, we'll also see timing differences. That's the next class in this sequence, financial accounting. There are other timing differences that you'll learn about. Not every error like this, not every overstatement or understatement is a timing difference. They don't all eventually balance out. And actually, most errors never balance out. But every once in a while, you find one that does. And so this is an example of that. Just to sort of summarize, it's called a timing difference. It is true that retained earnings at the end of 2024 will eventually get back to the correct number if you don't make any error corrections at all in your books. However, for each of the 2 years, 2023 and 2024, anyone who is relying on your income statement is going to be relying on incorrect numbers. And so that continues to be a problem. Okay, Andrew, was that helpful?
Yes, thank you.
Sure. Okay, other questions? Going once and going twice. Okay, so I'm going to close down the textbook, close this down, start talking about the project. Now, if you look ahead, and I'm not going to open up the syllabus because this is something that's going to come up in the future. And I don't want to deal too much about the accounting in a future chapter until we actually get there. But if you were to open a syllabus, you will notice that we do have a chapter on what is essentially long-term liabilities. Okay, it is chapter 14, long-term liabilities. What is a long-term liability? It's a liability or a debt that you probably are not going to have to pay this year, but you'll have to pay it in the future. Often, debts that you have to pay in the future are dependent on certain things happening or not happening. And what do I mean by that? Well, if you buy a computer, and if the sales price, what you agree to pay, is $400, and if the vendor of that laptop computer says, okay, pay me in 30 days, then you know exactly how much money you'll have to pay in 30 days. It'll be $400. But what if it's a home mortgage and your mortgage payment is $1,000 a month. Well, you may say, this year, I'm pretty sure I'm going to pay $1,000 a month. But next year, they say interest rates might be going down. I might, therefore, be able to renegotiate my interest rate to a lower number and therefore change the liability, change what I will pay. It's also possible, it hopefully won't happen, maybe there'll be another pandemic. Maybe banks will be essentially paid by the federal government not to give people a hard time if they can't pay their mortgage payment. Maybe you'll get to a point a year from now when that happens, and you'll call the bank and say, under my right, under this new federal law, I'm not going to make this mortgage payment. Well, let's go the other way. Maybe you're going to want to build, times are good. Next year, you might want to build an addition on your house. Well, you might take out supplemental debt, a supplemental mortgage amount. And that might increase the amount that you pay beginning next year on a monthly basis. The point is that the longer term the liability, the longer amount of time is going to pass until you actually make payment, the more uncertain the liability amount actually is. One of the biggest uncertainties involve lawsuits. Someone sues you. You say, I don't think I'm guilty. I'm going to fight this in court. Well, many, if not most, court trials last a year or more. Well, that makes this a long-term liability. Sometimes, not often, but sometimes companies are pretty sure, okay, I'm going to fight this in court, but I'm pretty sure I'm going to lose. And when I do lose, I'm pretty sure I know what I'm going to have to pay. It might be the maximum because I really am guilty. Well, if that's the case, then you might decide to fight the case in court anyway, but there's not much uncertainty. Otherwise, most of the time, when you get sued and you decide, I'm going to fight the case in court, you really are not sure at all what you will end up having to pay, if anything. That kind of liability, which is usually a longer term liability related to a more complex situation that takes time to work out, that's called and this won't be on the quiz for next week. It actually won't be quizzable until we get to chapter 14. But just to give you the official term, it's a contingent liability. CONTINGENT. Something that is contingent in the basic English language sense of the word means it may or may not happen. And if it does happen, it might come in at a different value. You're just not sure. It depends on what happens between now and then. Or to sort of flush out the basic English language verbiage, the actual liability amount is contingent upon, it depends on certain events rolling out or occurring in certain ways. And because you cannot necessarily predict the future, you don't know how those events will roll out or materialize, and therefore you don't know for sure what the liability will be. Okay, the liability is contingent on certain events occurring in certain ways. Well, okay, another way of calling this, instead of calling it a contingent liability, you'll see accountants refer to them as contingencies. 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 It's another way of saying contingent liability. Okay, so one of the primary reasons why you have an uncertainty or a contingency on a lawsuit, a legal case where you're getting sued, is a problem pops up. It could be your fault. But what does the management team that manages your company do about it? If the management team is competent, it will immediately reach out to people and groups that are affected. It will try to communicate with them. It will try to be responsible. It will, frankly, acknowledge some responsibility, but maybe not with too much detail because it's afraid of admitting too much because it would become easier for people to sue them. But if you acknowledge that you are at some fault and that even if you're a little bit fuzzy about what that fault is, and you clearly try hard to work with people who are negatively impacted to help them deal with the problem that you have caused, then they are either much more likely not to sue you or sue you for a lesser amount because you have helped them limit the damage. In addition, there could be government penalties, government fines. I'm going to fine you, F-I-N-E, charge you, a fee for having caused this problem. Well, if you can demonstrate that you're working collaboratively with people and organizations that are negatively impacted, damaged by what you did, then often not only will your lawsuit liability be less or zero, but the amount of the government penalty will be less or zero as well. Okay, so let me pause for a moment. Does that make sense to everyone? Hopefully it makes a certain amount of common sense, if you will. Okay, good. So, where was I when we canceled our class the day after Valentine's Day? I was actually working with Deloitte. Deloitte is one of the big four global accounting firms. Their national training center for their staff members and their management teams. They also invite some clients, some faculty members, etc. They have a national training center, a very large facility just outside Dallas in a town called Westlake. They actually call it Deloitte University, but you cannot get accounting degrees there. It's just the name for their training center. And basically they invite me up there from time to time to work with them on this very issue. Because when you're a public accounting firm, you need to walk into a situation from time to time where there's a lawsuit or at least a potential lawsuit that is being dealt with because a company has done something wrong. And it's your job as an accountant to try to figure out what that liability, that contingent liability is. Basically, you can't really know what that liability is. It will take time to work out, but you have to take your best guess at what it is or what you will wind up paying, if anything. And it is your best guess which winds up being a liability in your general ledger. Because your best guess is dependent on how well or how poorly the managers of the company that did something wrong are managing the situation. Very often, as an accounting firm, you sit down and you have to talk to your client about how to handle such situations, right? How to deal with it, how to deal with other people. And in that moment, you're not just their auditors, you're also their consultants. Because you're not just saying, hey, look, if you handle the situation in certain ways, the liability will go down on your books and records. You're also saying, for purely managerial purposes, you need to manage this in an effective way, and this is how you do it. In other words, this is not just a discussion that makes sense so that you know what the appropriate journal entry is. This is also a discussion that makes sense because it's good management practice. The bottom line is this is the case. And again, I just wanted to introduce it to you. This is the case today that I talked to, that I'm continuing to talk to Deloitte about. It's called Save the Blue Frog. And basically, it's about a major energy company that gets a really big contract to develop an energy project on a geographic tract of land that currently is not developed. And after they get the project, but before they actually begin construction, all kinds of problems start to occur. They start to pop up. And so even though there's a wide variety of different problems, each one of which needs to be managed, each one of it which raises the two questions: what should we do as the company to manage the problem? And then what is the impact of what we are doing on the estimated contingent liability? The blue frog itself is an endangered species that happens to be discovered living on the construction site. If you construct, you could wipe out an endangered species, which has certain ramifications above and beyond the death of an animal, because there are many people who care deeply about the life and well-being of certain animals for different reasons. And so the possibility of wiping out a native species is just one of a number of problems that are faced by the managers of this company in this project. However, since it's one of the more colorful issues that must be confronted in this teaching activity, in this learning case, we named the case after it. And so in this project, what I intend to do is walk you through exactly the same material, the same learning activity that I'm walking through with Deloitte. There'll be a little bit of complexity in terms of advanced accounting that I'll have to pull out. But fundamentally, I'd say 80% of this learning activity will be the same. And specifically, the relevance of this is a practical extension of the contingent liability material in Chapter 14. Now, Chapter 14, when we get to it, you'll see, does cover this, but it covers this sort of in passing. I mean, for some reason, the textbook author is just much more passionate about explaining the difference between a mock-up cancellation and a mock-down than he is talking about contingent liabilities. But as you can imagine, if you're actually running a company and you need talented employees to help you solve problems, they usually pay more attention to something like this than to the difference between mock downs and mock up cancellations. So I can't do without teaching you anything about mock downs and mock up cancellations, right? We covered that today. But I also want to make sure that we also cover the kind of material that you are much more likely to spend more time on if and when you proceed with what I hope is the plan for a good number of you to actually practice accounting. One final comment about that, and we'll call it a day. Many of you might be making the mistake of thinking, well, I'm only minoring in accounting, or I'm only getting a certificate of some kind in accounting, so I'm not majoring in accounting, so I don't have to worry about this. Actually, you do. If you're a finance major, contingent liabilities reduce the value of a project or a company that you might be trying to buy. And so if you're a finance major, you need to learn about this. If you're a management major, as I said, this is not just a concern of what is the right liability value. It's also a concern of how do I manage this situation? And actually, I'll go one further. I don't think there are too many marketing majors in this class. Might be one or two that might be majoring in marketing and minoring in accounting. But when we talk about issues like the value of an asset that we might think of as brand value or reputational value, at least for certain companies, if you start killing off native species left and right, especially one as visually attractive as that little bright blue frog in the lower right-hand corner of your screen, it hurts the value of the brand. It hurts your corporate reputation in much more dramatic ways than somewhat more mundane mistakes might. Okay, so that's just my introduction for now. We'll continue to add information about this as we go along. It is a complicated case, which is why I don't just want to wait until the end of the term when we're focused on so many different things and wrapping everything up to do all of the work. I'll continue to do these introductory conversations with you until we're ready to jump into it. Okay, any questions? Any questions? And going once. And going twice.